and co-host Cheryl Stokes from New American Funding. Hello, Cheryl.
Hello, Mary. How are you today?
Good. Hello, Cheryl. It is our housing update for September 2021. And, let's just kind of pop into it real quick. And we'll start sharing those slides, shall we? So, as we said, it's September 2021. And who knew what a crazy ride we've been on in this year. This is a question, Cheryl, that we're getting all the time from our buyers. Is the market cooling off? Well, let me get the right way there. No, it's not. Look at pending home sales, Cheryl. Yeah, they've come down a teeny bit, as you can see from this slide. But check this out. Comparison with historically the levels about 100 from however, it's Keeping Current Matters is who we look at, and they got this data from National Association of Realtors. We're far above 100 from a market that's cooling off. Isn't that so?
Absolutely. I think we just took a little breather,
which we kind of needed for that perspective. Yep. Cheryl, go ahead and read what Odetta Kushi has to say, the Deputy Chief Economist from First American.
Sure. We are seeing some signs of softening in the housing market, but context is important here. We're still very much in a seller's market, but we are seeing some early signs of softening. And I think the word context is key.
It is key. And, headlines are meant to terrify, not clarify. And that's what we're seeing right now and a lot of things that are happening. If we look at showing time, which I know we've talked about it in the past, but it's how we schedule our showings mostly across the nation. And these are national statistics. You can see here that they have come down, and we're seeing that in our own listings, Cheryl. But let's look at where it has been in July 2019 was there by their index 123 versus 189.4. So from a year ago per se, and these are July numbers, versus August numbers, we've really significantly gone up, even though we're not as high as we were in March of 2021.
Right.
And so having said that, why don't you read what Ojo Labs is putting up for the real estate technology firm?
Sure. The U.S. housing market continues to be ultra competitive, even as new COVID cases surge. But new data shows the level of competition and ensuing price increases might be cooling off just slightly. Data shows that 49.6% of homes sold for more than the initial price in July, far ahead of the number reported in July 2020, when 26.8% of homes were sold above initial asking price, but below June's total when 50.4% of homes sold for more than initially listed. So it's come down a little bit.
It's come down a little bit. And in our market, we're seeing that still the hot markets are in the primary markets versus the secondary luxury home. Those are sitting a little bit longer, but the prices have gone up significantly.
Yes.
With that said, the new monthly listing counts from 2017 to 2021 nationwide, that big, neon green matches my shirt counts. Look at where that is with new listing counts. That is significantly lower.
Yes.
So we still have this demand. We still have low inventory, so to speak. This is national in thousands. We don't know what it'll be the rest of the year because our market here is a little bit different than the national market, but still significantly lower. Daniel Hale from Realtor.com, their chief economist, said if these changing inventory dynamics continue, we could see a wave of real estate activity heading into the latter part of the year. And that's what we're going to see. We're going to see that in our market. Cheryl, are you seeing signs of that as well?
I think so. I think it's already starting.
Yeah. And now, as we kind of breeze through some of these level setting slides, I'm going to play a game with you, okay, Cheryl? The game is this a normal market? And you're going to say normal or abnormal, okay?
Okay.
So this slide came all up. My game went away. I'm going to have to bunch and be bummed out about it. So I wanted the game. Mortgage rates. Cheryl, what are they today?
On average, we've got it at 2.86, but again, in context, and that is not a normal historic rate.
Yeah. Not normal. I'm going to go with not normal. Price appreciation, it's normally average is normal is 4.1. Nationwide, we saw 17.2% in our market, much higher. As of last month, it was 39%. Is that normal or not normal, Cheryl?
Not normal.
Month supply, usually 4 to 6. Today it's 2.5. And in our market, it's under 2. Cheryl, normal or not normal?
Definitely not normal.
Days on market, 52 nationwide. Today, 17. And I would submit that we're even less than that in some of our markets. Normal or not normal?
Definitely not normal.
All right. The point is that we go on and on and on, selling over list, offers per listing, sales price, dollars to listing price ratio. Everything on this chart checks out not normal.
Yeah, it's historically not this way.
No. So what does that mean to us? Is it affordable? That in the news, we're seeing that, Cheryl, right? All over the place.
Right.
The question is, you talk about this monthly payment increasing significantly. Would you say that it's increasing significantly?
I mean, again, we have to remember the context of it. Have housing prices gone up and have mortgage payments conversely also gone up? The answer is yes. But is it significant, and does it equate to the other things that are happening in the economy?
Right. So significant is crazy, right? And again, if we look at this line here in February, it was probably somewhere around 1,000, maybe 1,033. Same with the blue line per se. So it has gone up $1,255 for somebody. That might be a significant increase, but how much more are they making? And This next slide is rather interesting as it relates. Affordability context. Cheryl, talk about this one.
So in context, it appears that affordability might be decreasing because the prices are going up. But what we have to remember is that while housing prices have gone up, so has income. And this year alone, if you look at hourly versus weekly, weekly is more salaries, income has gone up 7%. So you have to take the increase in income and compare that to the increase in home prices. And is it still affordable? I'll give you a great example. You had $1,000 up there as a mortgage payment. If you take that $1,000 and you increase it by 16%, that payment, it's $1,160. Okay. If your income was $5,000 a month, which is about what you would need to afford a $1,000 a month payment, and that income increased by 3.2%, which is just under the increase in hourly rate, your new income would be $5,160. Look at that. The increase in income is exactly the same as the increase in payment.
Wow.
But with a 3.2% increase in income and a 16% increase in cost.
I love how you put that simply, it's equal, right? Which brings us to this next slide. This is what it looks like when the headlines terrify. But Cheryl, this was a March slide, March of 2021.
Yep.
And so what did we say affordability was? Let's just go back to that. Now 146.3. So it's come down from 175. But Cheryl, look at this when it relates to, 2008 of 136. We're still more affordable.
And that's what you really have to think about. Is affordability keeping up with the changing times? And it really has. Since 2006, home prices are up 41%, but income is up 55%. And interest rates, which is the third piece to this puzzle, are down by 50%. So when you put all of those together, the affordability is actually in great shape.
Yeah. Yeah. So people that are saying, and we get this a lot, I'm going to wait. Wait for what? Because with mortgage rates down and people low inventory, the trigger on that is prices are going to go up.
Right. And I'll give you one last piece. New rent on a new lease is up 10%.
Oh, wow.
So if you add all of that in, your income has gone up, rates have stayed down, and rent is up 10%. Is it affordable to buy a house? It really is.
Oh, without a doubt. We've been having that conversation today with one of our new employees that is looking for a place to rent. At 3.5% down, she's a first-time home buyer. It would be better for her to buy a place than to rent.
Absolutely.
And
I speak to first-time home buyers all of the time. And once they realize that, one, they qualify, but two, while qualifying, that their overall monthly cost, including taxes, including insurance, is less than they're paying in rent, it doesn't make sense to continue to rent.
It does not. Now, on the other piece of that, which is rather interesting, percentage of income needed for a mortgage payment increasing as home prices continue to climb. So, Cheryl, context, right? Let's talk about this as it relates to 17% looks like outrageous compared to January of 2019.
Right. But it's absolutely not compared to what we say the percentage should be. 17% of your income is well below the requirements for qualifying.
And so this historic norm is what, 21.2?
Right.
And let's kind of look at what some of the Freddie Mac and some of the other ones are saying. So go ahead and read this.
So here it's saying most lenders agree that you should spend no more than 28% of your gross monthly income on a mortgage payment, including principal, interest, taxes, and insurance.
And then let's see. Did I hit the wrong button? No, okay. Sorry. Let's
and
see
then
what
if you add
NAR,
they say the 25% mortgage payment to income share takes into consideration that the homeowner has other expenses such as property insurance, taxes, utilities, maintenance, total housing expenses are no more than 30% of income. Housing costs are not burdensome if they account for no more than 30% of your income. So on the last slide, we were talking about 17%. And here they're saying 28 and 25. And those numbers move around a little bit in qualifying. But right now, it's still showing that it's quite affordable to purchase a home.
Right. So this slide sums it all up. 25 by
Your
NAR.
mortgage payment as a percentage of income right now is at 17.1%.
Which is less.
Which is less.
Right? So buyers that are worried about no one, dollars coming down on the prices, which were at historic low inventories, and people's ability to buy, we've kind of taken that out of the equation.
Correct.
Right? From looking ahead, if we kind of go down this path of now price, these three, MBA, Freddie Mac, Fannie Mae, and NAR, on average say that it's going to be a 5.5% increase in 2022 in housing prices, which I think in our market will be higher than that, but we've been historically higher because of what's happening nationwide and why people are flooding to Southwest Florida.
Right.
But go ahead and read this, Cheryl, by George Rettia.
Sure. I expect an unusually busy fall season. Sellers are putting homes on the market. Normally, this activity happens in the early spring. And this is from George Rettia, Realtor.com's senior economist.
This is when we start to list in Southwest Florida because of our snowbirds coming down. But we're seeing it in our primary markets as well, Cheryl. It's not just our secondary markets that are listing in the fall. This is pertaining to someone that lives in a primary market, and our primary markets are also looking to list as well.
They're staying healthy. They haven't stopped moving.
That's right. Exactly. So really what's happening in our area, I brought out this flavor of the slide last month, 2021 year over year Naples Board of Realtor market data. Our new listings are down 22%. Our homes for sale are down 74.8%, almost 75%. But our average closed price is only up by 1.9. Now, everybody goes, oh, what happened to the 30 and the 40 and the 50, Mary? We were talking about. This is year over year. Last year in August, these are August numbers, they were driving up, okay?
Right.
When we normally go down. And in this August, we did our normal go down. So prices went down, which people that have left it on the market that didn't have to sell, they took it off, but they just wanted to leave it out there. Those prices have come down. That's not to say that we haven't seen that appreciation. I'm going to show that in a slide in a hot minute. Showing time, which is, again, where we go in and book our showings. This particular slide shows that look at over time from 14 all the way out to July of 2021. This is the South region. Showing time
Right.
changed their reports. So South region includes Florida and other states in the South. They have about 5 regions now. You can see that our showing time, the South region is orange and the blue is United States. We're about the same, right? They've come down, but that's not unusual when you look at the zigzag on this chart.
Right. And it's like we said at the beginning, it's always important to take all of these numbers in context and look at averages, not just one number at a time, because one number can be deceiving. You have to look at the whole picture.
Well said. Now, let's look at this of Collier County pending sales. You already know we're down, a whole boatload of listings, right? We're down like 75%.
Right.
But look at the pendings. The pendings actually, which is kind of crazy, went up here from, this is August data. So the last 2 months, the pendings did go up. But what we saw, which I thought was interesting, and we did need a breather, people started to move about. Cheryl, they got sick of COVID. They could travel. Their kids were out of school, and they were ready to explode and go and see places. And that's what we saw. They know housing's going to be there. They still want to move, but they just took a breath. And so some of our inventory has been on the market a little bit longer than we've seen in the past in this year, but that's okay because they're going to come back.
And as people move more, those pending sales are going to continue to rise.
That's right. That's right. But we need that inventory. I will tell you, Cheryl, that is most critical.
Yes.
So again, we've shown this in the past. We have a historic seller's market. Why? Low interest rates, low inventory, and the home buyers are headed to Florida in masses. They're tired of the high taxes. They want to get to where they've always wanted to live, and they're ready to fly as it gets out of those cold states with crime and all the other things. I have a client from Chicago that lives downtown, Cheryl, and he said that, and if you're from Chicago, this is not a ding because that's where we came from. So both a friend and a client of mine, he said, Mary, we moved from the burbs downtown when we became empty nesters. And he said, I've had gunshots where I was last night, he said, right around me and on the running path near the lake in downtown Chicago, shots were fired. He's like, what am I doing? Right? I have crazy taxes, bankrupt. It's going to be cold. Maybe it's time to move. Thoughts?
My thoughts? Sorry. Sorry, I was lost in the conversation there. Yeah, it is time to move. And it's not only just low interest rates, low inventory. Maybe you want to live somewhere else. It's higher rent. The interest rates are low. They're going to stay low as far as we can tell, but it's not a forever thing. So all of these factors, I think, lead you to believe that it's still time to move. It's still time to take advantage of that because these numbers could change.
Yeah, absolutely. So Cheryl, here we are at the end of September or middle. I guess it's not quite the end, right? Almost. It feels like the end. I don't know. It feels like a morph of time. We've seen quite an amazing year. We saw a crazy going up. We saw it crazy, a breath taken. I think we're gearing up for that next wave of high demand. But my friends, if you own a home and you want to do something different with it, it is time to list now because inventory will increase. Maybe not. It won't ever be not a seller's market in the next year, but it will increase. Hey, Cheryl, we have a question Here, hello, Cheryl. Please tell us the interest rates for conventional and jumbo loans.
Well, that's the question that I hear on a daily basis. And I will say what I tell everyone: each individual loan is unique. Each individual loan has a different set of criteria and a different borrower. So it's impossible to say this is the rate today. When you see those interest rates advertised, you don't see the fine print that it's based on a certain specific criteria. It's just not there. But I can confidently say that on average, every borrower is somewhere in the threes. And I can confidently say that 3 years ago, they were not. They were in the fours and fives. So it's still very affordable. They're going to be somewhere in the threes, most likely. And that's a very, very affordable interest rate that is still historically low.
That's awesome. Thank you, Isabel Nunez, for asking that great question. If you have other questions or you'd like to learn more, please feel free to comment below and we'll watch it as we prepare for the next month. But again, I'm Mary Bartos with the Bartos Group of Premier Plus Realty, and I have my sidekick,
Cheryl Stokes, New American Funding.
And we look forward to seeing you next month in our housing update. Ciao.